Hi, welcome to SP School of Production Management newsroom. So the current news is in the last week you might have heard about LIC coming out with IPO, and we need to open demat account in order to subscribe to it. So likewise, several people might have talked. What is doing between investing in equity share and investing in insurance product? So this we need to understand fundamentally because many people might be investing in insurance, but they might be new to IPO investment. So what is the difference? You might have heard about gambling. Say there are some four friends and they are going to play some games. So what they will do means each one will pay 25 rupees and they will make collect a fund of 100 rupees. Now whoever is going to win, they will pay the 100 rupees to that person. This is not allowed by law. Why? Because the purpose of this activity is not correct. Because this will induce person to play more and lose more. But if the purpose is good, then it can be allowed. Say for example, if four friends are going to pay 25 rupees and if any person has some loss, then they are ready to give the 100 rupees to that person who is getting any loss, and we are going to set off the loss with the help of this 100 rupees. Then the purpose is good, and because of this we can allow it. This is the concept behind insurance. Say for example, if there are 1 lakh persons in a factory, so if there are 1 lakh people in a factory, and those 1 lakh people, they all contribute, say for example 100 rupees. That means they can collect totally 1 crore rupees, and with this they are going to pay to a fund and insurance company. And if something happened to any one of the person, say at most some 6 to 7 persons can met with accidents. So in that case, for those 7 people, what they can do means the insurance company will pay 10 lakh rupees each. So they have collected 1 crore rupees and they are going to pay 10 lakh rupees each. So they are going to pay 70 lakh rupees. So then balance 30 lakh will be there. So out of this 30 lakh, 5 lakh they can use it for fund management purpose, and the remaining 25 lakh they can also share it with the people who have given the money as bonus. So this is the concept of insurance. Each one is going to give some small sum of money, and whoever is going to have some loss, they are going to set off the loss with this money. So this is nothing but sharing of risk. Here this kind of transaction is called life insurance because they are going to share for if life risk. On the other hand, there could be general insurance also. If some motor vehicle accidents happen or if some crop accidents, some crop loss happen, then in that case also some companies will give insurance. So those things are called as general insurance. Whereas in case of life insurance, so here what we are going to do means, say if some person is going for some foreign countries, so in that case they are going for some 3 years, 5 years. So in that case, what if there is any life risk happen during the 5 year period, then the insurance company will pay the money. But if nothing happens, then the company will not pay anything. So this is term plan. So during a 5 year during foreign stay, his family is secured. That is the idea behind term plan. But some people will tell, I have paid for 5 years or 10 years, nothing I have got it. So in that case, we are having endowment plan. So in endowment plan, for 10 years for the term, they will pay the insurance. But on the other hand, if some loss happen in between, the money will be paid. But if no loss happens, then some portion of the money will be paid after the end of the term. That is endowment plan. So this has the concept of insurance as well as the concept of saving. That is the idea behind endowment plan. And here, if it is for 10 years, they will pay at the end of 10 years. If it is 25-year plan, they will pay at the end of 25 years. So some people tell you after 25 years, what is the benefit in getting the money? It is not useful for current requirement. So in that case, they are having some plan called as money back plan, where once in every 5 years or once in every some equal interval, they are going to pay some fixed sum of money. That is the idea behind money back plan. Likewise, they are having several insurance products, and LIC is having life insurance business. Now, already they are running company and they are going to offload their shares in the equity market. Up to 5% of value they are going to offload it. Now, what is equity investment? Say for example, there are 1 lakh people are there in a village, and in that village or in that district, there is no food processing. They are food processing factories. So, what these 1 lakh people can do, they can ask the government to set up a factory, or instead what they can do, they each one can pay small sum of money, say 100 rupees they can pay, and they can collect the money worth 1 crore rupees. So with this 1 crore rupees, they can start the factory. So for this factory, the capital is 1 crore rupees, and all these 1 lakh people are shareholder, and each one is having ownership up to 100 rupees. So they are sharing the ownership up to 100 rupees. So this is the equity share value. This is the equity share value, and this is the total money with which the company has started. Now, after 1 year, if the company makes any profit, then the entire profit will be shared with this 1 lakh shareholders. And if any loss happens, then also the loss will be shared with 1 lakh shareholders. That is the idea behind equity investment. So all are shareholders of the company, and what they are going to do means they are going to run the company with the help of some promoters, and they are going to have the shares continuously. They are going to have the shares as long as the company is there. Their shareholding will be there. But in between, if they want to reduce the shareholding, they can sell the shares in the secondary market in NSE or BSE. That is the idea behind equity investment. And here they can take part in decision of the company by way of voting, and they can share for the profit and loss. Whatever profit the company is getting, they are going to get bonus. But whatever loss, then the investment will suffer. Because of this, what we are supposed to note down means we are taking the risk of the company. If the company make profit, we will earn. The company make loss, we are going to suffer. So we are bearing the risk. So if in between, if we did not want to hold the share, what we can do means we can sell the share in the secondary market. But in this case also, what will be the share price? Say if we have invested it for 10 rupees now, then afterwards, after 1 year, 2 year, 3 year, the share price will rise. It will rise to 100, 200,000 likewise. But all of a sudden, it can also go back to 2 rupees or 5 rupees. So share price will rise or it will fall also. So we can't tell in which direction share price will move. So it is a volatile investment. Every day it will change. So that is a risk in shareholding. Now, whether to invest in equity or in insurance product. Since LIC is going to issue IPO, it does not mean that this IPO has the features of insurance. Insurance is a separate thing. In insurance, we are going to offload our risk. We are going to reduce our risk. On the other hand, in IPO, in equity investment, we are going to bear the company's risk. So they both are different things. Since LIC is going to come out with IPO, it does not mean that this IPO, this equity investment is completely safe. It has all the pros and cons of equity investment. So if we want to invest in this equity investment, we need to go through the detailed prospectus, and we need to understand each and every pros and cons, and thereafter only we can invest it. So we will discuss the pros and cons of those investment in the next video. Like and share our video and subscribe to our channel. Thank you.